In 2008, the global financial crisis wiped out 55% of the S&P 500. Trillions of dollars. Gone. The average investor who panicked and sold at the bottom didn't fully recover for years. Some never did. But there was one portfolio, quietly sitting in the background, that fell just 12%. Not 55%, 12%. And while everyone else was selling in a panic, the people holding this portfolio barely flinched. They kept compounding, and when markets recovered, they were already ahead. This portfolio has been quietly beating most investors' returns on a risk-adjusted basis for over 40 years. It was built by the founder of the world's largest hedge fund, and until 2014, almost nobody outside of billionaires and pension funds even knew it existed. Today, I'm going to show you exactly what it is, how it works, and most importantly, how you can build it yourself in Australia with just 5 ETFs and about 20 minutes of your time. To understand the all-weather portfolio, you need to understand the man behind it. Ray Dalio grew up in a working-class family in New York. His father was a jazz musician. As a kid, he caddied at a golf club, carrying bags for wealthy Wall Street types, watching how they talked about money. At 12 years old, he bought his first stock with his caddy tips, Northeast Airlines. It tripled. He was hooked. After studying at Harvard Business School, Dalio founded Bridgewater Associates in 1975 out of his Manhattan apartment with basically nothing. No investors, no backing, just a phone and an idea. Today, Bridgewater is the largest hedge fund in the world, managing over $150 billion in assets, and Dalio himself is worth somewhere north of $15 billion. But here's the thing about Ray Dalio that separates him from most investors. He doesn't just try to pick winning stocks, he thinks in systems. He thinks about how the entire economy works, and then he builds portfolios designed to survive whatever the economy throws at them. And that obsession, that question of how do you build a portfolio that performs well no matter what happens next, took him nearly 20 years to fully answer. The result was the all-weather portfolio, created in 1996. Initially, it wasn't even available to normal investors. Dalio built it to manage his own family trust. It then became a product for Bridgewater's institutional clients, pension funds, sovereign wealth funds, large corporations. By 2011, the all-weather fund had grown to $46 billion. The rest of us didn't find out about it until 2014, when motivational speaker Tony Robbins interviewed Dalio for his book Money, Master the Game, and Dalio, for the first time, laid out a simplified version that anyone could replicate at home. What Dalio told Robbins that day is what we're going to unpack together right now. So what exactly is the all-weather portfolio, and why does it work? The core insight behind it is both simple and profound. Dalio's view is this: nobody, not him, not Warren Buffett, not anyone, can reliably predict what the economy is going to do next. And if you can't predict the future, then building a portfolio that only performs well in one type of environment is a gamble, not a strategy. Instead, Dalio asked a different question. What if we could build a portfolio that performs reasonably well in any economic environment? And to do that, he mapped out the 4 economic seasons that the global economy cycles through. Season 1, rising growth. The economy is expanding. Companies are making more money. Stocks love this. Season 2, falling growth. The economy is slowing down or contracting. Recession territory. Stocks struggle. Bonds tend to do well. Season 3, rising inflation. The cost of everything is going up. Your dollar buys less. Commodities and gold tend to shine here. Real assets hold their value when the currency doesn't. Season 4, falling inflation or deflation. Prices are stable or dropping. Bonds and stocks both tend to perform well in this environment. Now, here's the problem with most portfolios. The classic 60-40 portfolio.
60% stocks, 40% bonds, is actually heavily weighted toward one of those seasons: rising growth with low inflation. When that environment is in place, it looks brilliant. But when we hit inflation or a recession, or both at the same time, which is exactly what happened in the 1970s stagflation, and echoes of which we saw recently, a 60-40
portfolio can really struggle. What Dalio did was figure out which asset classes perform best in each of the 4 seasons. And then he built a portfolio that holds all of them. So no matter which season the economy moves into, something in your portfolio is working for you. He called this risk parity. Not equal dollar amounts in each asset, equal risk contribution from each season. The result is a portfolio that looks nothing like what most financial advisors would ever recommend.
So, what does the all-weather portfolio actually look like? Here are the 5 components and their allocations. 30% stocks, broad market equities. This is your growth engine. Stocks perform well during rising economic growth and stability. 40% long-term bonds, long-duration government bonds. These provide strong protection during economic slowdowns when central banks cut rates. Bonds go up when rates fall. 15% intermediate-term bonds, shorter duration bonds as a stabilizing buffer. Lower interest rate sensitivity, but solid diversification. 7.5% gold, the classic inflation hedge. When the purchasing power of currency falls, gold tends to hold or increase in value. 7.5% commodities, oil, agricultural goods, metals. Another inflation hedge that tends to move independently of stocks and bonds. Now, I know what you're thinking. That's only 30% in stocks. Most growth-focused investors are running 80%, 90%, even 100% in equities. Why so little? Here's the key insight. Traditional portfolios measure diversification in dollar terms. I've got 60% stocks and 40% bonds. I'm diversified. But Dalio measures diversification in risk terms. And here's the uncomfortable truth. In a typical 60-40 portfolio, stocks are so much more volatile than bonds that they actually contribute around 90% of the portfolio's total risk, despite only being 60% of the capital. You think you're running a balanced portfolio, but you're actually almost entirely exposed to stock market risk. The all-weather approach spreads risk more evenly across the 4 economic seasons. Less concentration in any single environment means much smoother returns over time, and crucially, much shallower losses when things go wrong. And that matters more than most people realize. Because of how maths works, a 50% loss requires a 100% gain just to get back to where you started. But a 12% loss only requires a 13.6% gain to recover. The maths of avoiding big losses is one of the most powerful forces in long-term investing.
Alright, so the theory sounds solid, but does it actually work? Let's look at the numbers. From 1980 to 2019, the all-weather portfolio returned an average of around 8.6% per year. Over the same period, the S&P 500 returned approximately 11.1%. So yes, on raw returns, the S&P 500 wins. But here's where the story gets interesting, because returns are only half the picture. The 2000 dot-com crash, the S&P 500 lost 49% peak to trough. The all-weather portfolio barely moved. The 2008 global financial crisis, the S&P 500 fell 55%. The all-weather portfolio's maximum drawdown was around 12 to 22%, depending on the exact implementation, a fraction of the carnage. The COVID crash in March 2020, stocks fell 34% in a matter of weeks. All-weather dropped just 6%. Now, here's the key question to ask yourself honestly. If your portfolio dropped 55% in a year, which is what happened to S&P 500 investors in 2008, would you actually hold? Or would you panic and sell near the bottom, locking in permanent losses? History tells us most people sell, and the investors who sell at the bottom and buy back at the top are the ones who underperform the index they were meant to track.
That's the real risk that nobody talks about. It's not just volatility, it's the behavioral response to volatility. When you suffer a huge drawdown of 50%, you need 100% returns to recover. But when drawdowns are smaller, you can start compounding at higher levels after the sell-off. The all-weather portfolio's shallower drawdowns mean you spend less time in recovery mode and more time compounding forward. And the data backs this up. The all-weather portfolio took approximately 50 months on average to recover from a major drawdown, while the S&P 500 took approximately 38 months on average, with the longest drawdown lasting 80 months. So yes, the S&P 500 has higher raw returns over long bull market periods, but on a risk-adjusted basis, measured by the Sharpe ratio, which divides returns by volatility, the all-weather strategy has historically delivered a Sharpe ratio of 0.67 versus 0.54 for the S&P 500, indicating superior risk-adjusted performance. You're getting more return per unit of risk, and you're sleeping
better at night. There's also one more thing worth noting. The all-weather portfolio had 38 positive years and just 5 negative years, a positive ratio of 88%, compared to the S&P 500's 36 positive years and 7 negative years. More years in the green, fewer years in the red. Less time recovering from losses. Okay, so here's what you've been waiting for. How do you actually build this as an Australian investor? Because the original version, Dalio described, used US-specific funds. But we can build a very close approximation right here on the ASX using 5 ETFs. And I want to be transparent. This is for informational purposes only. I am not a financial advisor, and this is not personal financial advice. But I will walk you through the building blocks. Here's the Australian all-weather allocation. 30%. Broad Share Market Exposure ETF. Option VGS, Vanguard MSCI Index International Shares ETF for global equities, or a split of VGS and VAS for local exposure. 40%. Long-Term Bonds ETF. Option VBND, Vanguard Global Aggregate Bond Index ETF hedge to AUD for broad global bond exposure, or VAF, Vanguard Australian Fixed Interest ETF for domestic focus. 15%. Intermediate Bonds ETF, a lower duration version of the above. IAF, iShares Core Composite Bond ETF, gives you broad Australian investment-grade bonds with a shorter average duration. 7.5%. Gold ETF. Option Gold, Perth Mint Physical Gold ETF, the ASX-listed physically backed gold ETF from the Perth Mint, as Australian as it gets. 7.5%. Commodities ETF. Option QCB, BetaShares Commodities Basket ETF, provides exposure to a diversified basket of commodity futures including energy, metals and agriculture. Now, a couple of honest caveats here. First, the commodities and gold allocations carry higher fees than vanilla equity ETFs. The diversification benefit is real, but so is the fee drag. Factor that into your thinking. Second, the bond-heavy nature of this portfolio means it can struggle during periods of rapidly rising interest rates, which is exactly what we saw in 2022. Rising rates pushed bond prices down, and the all-weather portfolio had one of its worst years in 2022 as a result. That's a real limitation worth understanding. Third, if you are younger, say under 35, and you have a long time horizon and a genuine iron stomach for volatility, a higher equity allocation might still make more mathematical sense over 30 plus years. The all-weather is not the only answer. It's one answer, and arguably the best answer for investors who have seen enough market crashes to know that the real enemy isn't volatility, it's their own behavioral response to it. The rebalancing rule. Once a year, set a calendar reminder, check your allocations and rebalance back to the target percentages. That's it. That's the entire maintenance requirement, 20 minutes a year. This is truly a set and almost forget portfolio. There's something deeper going on with the all-weather portfolio that I think is worth pausing on. Most investors, most of us, spend enormous mental energy trying to predict what the market is going to do next. Is a recession coming? Should I be buying or selling? Is now a good time?
And the research is pretty clear. We're terrible at it. Professional fund managers, on average, underperform a basic index fund. Not because they're not smart, but because predicting the future with enough consistency to beat the market is genuinely, extraordinarily difficult. Dalio's insight was to stop trying. Instead of asking, what will happen next, he asked, what should I hold so it doesn't matter what happens next? That's a fundamentally different question, and the all-weather portfolio is the answer to it. You're not betting on a bull market. You're not betting on inflation. You're not betting on anything. You're building a portfolio that's indifferent to prediction because it's designed to participate in whatever economic environment arrives. And there's a quiet confidence that comes from that. You don't need to watch the news every morning. You don't need to panic when markets fall, because you've already planned for the storm. As Dalio put it himself, if you can't predict the future with any certainty, then it makes sense to hold a mix of assets that can navigate whatever comes next. Elephants don't run from storms. They walk straight through them. So, to pull this all together, the all-weather portfolio was built by the world's most successful hedge fund manager to survive every economic environment. It's held up through oil shocks, the dot-com bust, the global financial crisis, a global pandemic, and one of the fastest inflation spikes in modern history. It won't make you the richest person in the room during a raging bull market, but it will keep you in the game, compounding steadily, sleeping soundly, and never being forced to sell at the wrong time. And for most investors, especially those of us who have lives to live outside of watching stock prices, that's a much better deal than it might first appear. If you found this useful, please leave a like. It genuinely helps this video reach more people who need to hear it. And if you want to go deeper on building your own investment portfolio from scratch, including how to open a brokerage account, how to automate your investing, and what to do in your super, subscribe and hit the bell. That's exactly what we cover on this channel. I'll see you in the next one.